All right, let's keep going in our discussion of kind of an introduction to managerial accounting. And we're going to talk about cost of goods sold. And we've had cost of goods sold before from, in financial accounting. We've had, we said, okay, well, this is what we sold, and this is going to be an expense item over on the income statement. And cost of goods sold is going to look pretty much the exact same on an income statement for a manufacturer, but then we have to understand some things here. And it says right here, to meet external reporting requirements, costs must be classified into three categories. We've got product costs or production costs. We're using this terminology because we're looking at a manufacturing environment here. And then selling and administrative. Now, for our purposes, what we're really trying to understand here is that we have costs of production, and then we have everything else. All right. So let's look here at some information about cost of goods sold, and then we'll look at how to calculate that. It says cost of goods sold represents the cost of goods that were actually sold during the period, and then transferred from finished goods inventory on the balance sheet to cost of goods sold on the income statement. Now, before we go any further, if you haven't, we've come across some additional vocabulary that we hadn't seen before. When we were talking about cost of goods manufactured in the previous video, we talked about an account called work in process, and now we also have finished goods inventory. So finished goods inventory is essentially, and I've said this before, but it is essentially the same thing as the inventory that you've been used to dealing with. So we want to understand something here is that for a manufacturer, let me get my lead out, that might help. For a manufacturer, well, maybe not. For a manufacturer, there are three types of inventory. We have materials, we have work in process, often abbreviated as WIP. And these are items that have had materials placed into the manufacturing process, but we aren't finished yet. I gave you the example of some direct labor that involved, painting a birdhouse. Well, think about those birdhouses before they were painted. They would be part of work in process. And then finally, we have finished goods. And before we can really sell a product and allow it to become part of cost of goods sold, I think it makes sense, that it has to be finished. Okay, so these are when we look at a balance sheet for a manufacturer, we're going to have three different amounts for our inventory. Okay, so now we have a formula here. It's beginning finished goods inventory, which is, we're always going to start with beginning. Think of this, pretend there's a plus right here. So we're going to say beginning finished goods inventory. This is a positive figure, plus cost of goods manufactured, not purchases. We only use purchases when determining the amount of materials that were used in production, and that's, you need to review, go back. That's part of the cost of goods manufactured formula. So this middle component of our formula is always going to be a plus, minus ending finished goods inventory equals cost of goods sold. So with cost of goods manufactured, we had to consider our beginning work in process inventory and then our ending work in process inventory to account for the portion of that work in process that that incurred costs, but maybe, how much of that was actually completed, right? But now we're trying to determine how much was actually sold. So we have to have our beginning and our ending finished goods inventory, because again, it has to be finished in order to sell it. And then we need that cost of goods manufactured. It says here that the primary use of the statement of cost of goods sold, and this is actually an actual statement, is for external financial reporting. I think what we want to say is the results of the statement of cost of goods sold is going to appear on the income statement. I don't know how many external users are going to actually look at the statement of cost of goods sold. They're probably just going to look at the line item on the income statement. Perhaps that's a minor point. So example 2.5, how to calculate cost of goods sold. We're back to our Blue Denim Company example. It says that during the month of May, 115,000 pairs of jeans were completed at a cost of goods manufactured of $575,000. We already did this math. If you don't believe me, you can go back and look at your slides if you're in one of my classes, or look at the previous video if you're not. So what we would say is that well, let's keep going. Suppose that on May the 1st, Blue Denim had 10,000 units in finished goods inventory costing $50,000. And on May 1st, the company had 26,000 units in finished goods inventory costing $130,000. If you don't mind, what I want to do just for a moment is I want to focus on this $575,000 here of the cost of goods that we manufactured, and then I also want to focus on our beginning inventory. And what I want to tell you is that our beginning inventory of $50,000, okay, plus our cost of goods manufactured of $575,000. I don't believe this was on the slide. That's going to equal $625,000. And you're thinking, well, yeah, I could probably do that in my head. So, but this is what I want you to understand. This $625,000 is, or in math terminology, equals what? Cost of goods available for sale. And that is terminology that is used more often in for a merchandiser. This this cost of goods available for sale. Goodness. But if we can look at that and focus on that and say, okay, beginning inventory plus cost of goods manufactured is going to give us cost of goods available for sale, that might help us a little bit in calculating our cost of goods sold. All right, so it says here on May the 31st, the company had 26,000 units in the finished goods inventory costing $130,000. So what that tells us, if we think about it, is we had $625,000, the $575 plus the $50,000 beginning inventory cost. We had $625, and we still have $495. I'm sorry, we still have $130,000. That's going to give us $495,000 for cost of goods sold. So I'll let the cat out of the bag a little bit early there. It says required, prepare a cost of goods sold statement for the month of May and calculate the number of pairs of jeans that were sold during May. Okay, so that's pretty easy. So again, we had cost of goods manufactured of $575,000. I realize that this is not in the same order as the formula, but this is an actual cost of goods sold statement. So we're going to look at cost of goods manufactured first. We're going to add to that the $50,000 of finished goods. And again, I would, if it were me, I would put a little arrow right here, and I would put $625,000 goods available for sale, minus finished goods inventory of 130,000 because we still have it. If we still have it, it could not have been sold. Gives us cost of goods sold 495,000. So let's just bring our calculator over here. Goods available for sale 625,000. These two figures minus the 130,000 that we still have equals 495,000. All right. Now they want to know how many units did we sell? Well, it's the exact same thing. We take our beginning inventory of 10,000 units, and then we take the number of units finished. That's 115,000. So there were 125,000 units available for sale, but as of the end of the month, we still had 26,000 of those. So we're going to subtract that out. Not because we don't have them, but because we do, and they haven't been sold. So units sold during May is 99,000. You may recall that when we calculated our cost per unit, it was how much? It was $5. There it is. We can actually go backwards here, and we can actually do this and calculate cost of goods sold per unit, $495,000 cost of goods sold divided by the number of units sold gives us that $5 that we previously calculated back when we were looking at our fixed and variable cost component, I believe is what we were looking at. Or no, is that right? No, I'm sorry, that was direct materials, direct labor manufacturing overhead that had been allocated. That's what it was. Okay, I remember now. All right, so let's see what we have here. So one more slide and then we'll wrap this up. So it says here, relationship between the flow of cost, inventories, and cost of goods sold. I got to tell you, I don't care who you are or where you're studying this topic. If you can get this part down right here, the flow of costs between the balance sheet and the income statement. Inventories are on the balance sheet, cost of goods sold is on the income statement. You can figure out any of this stuff, any of it. So here we have those calculations that we were using before. We had direct materials cost of $210,000. That is an inventoriable cost. We had direct labor. They put these two together because they're conversion costs. $135,000 of direct labor is going to go into the work in process inventory, meaning we can't start working on it until the materials have been added into the process. And then we're going to apply manufacturing overhead of $150,000. That goes into work in process. That is an inventoriable cost. All of these figures combined here, let's see here, are going to give us our total product cost. Now we had some, and then so we do all of this, and let's see here now. We have finished goods inventory, and then whatever we have left, that's at the end of the day, we're going to subtract out of our total cost of goods available for sale to arrive at cost of goods sold. So we have a little legend over here. It is quite detailed, and so for that purpose, for that reason, I don't really have the time to get into all of this. But you can see the flow here for all of these different movements. And if you can use this little legend over here, I think it will help you understand the process. And then they've got basically just kind of a little glossary that it's another legend to show you what all of these little abbreviations mean. If you don't know what these mean, you need to figure it out. You need to use your ebook, or you can use the World Wide Web. These are all terms that are very, very common. The only caveat that I would issue is that if you do any kind of research on cost of goods sold, do be advised that you're going to be primarily presented with formulas based on it for a merchandiser, not for a manufacturer. Okay, but we need to understand these terms, and we need to understand what is going on, this flow of cost. If we can do that, we'll have it whipped. All right, that's it for this video.